How to make £1,000 a month in dividends. This is not financial advice. Please do your own research before investing. Whether you are just entering the investment world or are already an experienced investor, you may well be looking to get the best dividend returns for your cash. If you really want to hit that passive £1,000 of dividends per month target, on a pre-tax basis, which works out to £12,000 of dividends per year, your portfolio value will have to be anywhere from £250,000 to £1.2 million in size. Not a figure for the faint of heart. So how do you make £1,000 a month in dividends? How much will you need to invest to generate that amount on a post-tax basis? And finally, how can you guarantee monthly returns? Let's take a closer look. It's the dividend yield you need to consider when working out your passive returns. The yield is calculated by dividing your yearly dividend per share by the current share price. A high dividend yield will grant you a maximum payout, but it's unlikely to do much in terms of growth. It might therefore be worth looking into smaller yields that you can build up over time. It's never a good idea to go charging into large yields to begin with, as they are not only tricky to keep up to, but they likely won't sustain you over time, either. It is important to remember that dividends are subject to taxes just like other streams of income. The only exemption is for the investments that are held in a tax-free account such as an ISA. Aside from the first £2,000 in dividends, generated outside an ISA, you will have to pay income taxes on the rest of your dividend income. Thankfully, this rate is lower than the normal income tax rate. Nevertheless, it must be factored into your calculations. Depending on which tax bracket you fall in based on your other sources of income, you may actually need to generate a significantly higher amount in pre-tax dividends. In the worst case, if you are in the additional rate bracket already, you may actually need to £1,649 in monthly pre-tax dividends, £19,786 yearly, to generate the £1,000 in after-tax dividends. Before you start making any strides in company investments, it's important to consider which avenues to choose. By this, I don't necessarily mean the specific companies, but the types of investment available to you. To gain dividends, you'll generally have the choice between individual stocks, or ETFs. As you may know already, ETFs bring together a range of different options so that you can diversify your options. Therefore, if you really want to maximize your chances of making that cool £1,000 per month while reducing your risk, it's worth going the ETF route. Bonds are also an option for generating income, although technically bonds pay coupons, not dividends. Nevertheless, if you invest in an index fund or ETF that holds bonds, the distribution will generally be called a dividend. So aside from the semantics, bonds can also be considered in your list of options. It's worth looking into individual investments only if you have the time, knowledge, and inclination to follow the company and the broader markets properly. If that doesn't sound like something you would be interested in, you are much better off just buying the funds I have discussed below. When you invest in the market, your returns come from both share price appreciation and dividend income. Often people see the two streams of returns as separate, and the discussion becomes, should I go for growth or for income? The growth versus income debate in my mind is misplaced. From a purely financial perspective, one should opt for a portfolio that maximizes total return, which is inclusive of capital gains, rising share prices, and dividends, while minimizing risk. In simple terms, what this means is that your portfolio should be allocated in such a way that you are not concerned about whether your returns are coming from dividends or stock prices going up, you just want the best returns overall. In fact, since capital gains are typically taxed at a lower rate, it is more tax efficient to generate your income by selling down units of the fund that have gained in value rather than to receive an equivalent amount in dividends. For our situation, let's consider a simple example. let's assume that your portfolio grew by £1,200 in value in a given month and £500 of this came from dividends. This means that you can sell down an additional £500 of your holdings to generate your target income, and meanwhile still have the portfolio grow by £200 in value. This is significantly more tax efficient as well. The astute reader will ask what happens when the portfolio only goes up £600, meaning £500 came from dividends and £100 from share prices. In that case you will not be able to generate the full £1,000 in dividends, right? Well, that is correct. That is the one drawback of this strategy, and the way to adjust for that is to sell a little extra holdings when the portfolio is really up, and hold some cash in reserve to draw upon. It sounds more complicated than it really is. Nevertheless, if that sounds like too much trouble for you, then I think this video will really help you reach your goal, generate the £1,000 of dividends a month, and do not worry about anything else. Naturally, I'd never suggest leaping straight into an investment just for the dividends without considering a few important points first. Of course, the first thing to consider is how much you want to actually invest. There is always going to be risk, and just because the initial maths suggests that you could make £1,000 per month from dividends, doesn't ever mean it's a guarantee. Beyond this, never invest more than you can afford, keep an eye on your outgoings and don't overstretch, no matter how positive the signs may be. It's also a good idea to avoid investing purely because the dividend yield is healthy. A big company with an equally big yield will naturally be very attractive in the first instance. However, smaller investments in smaller companies are more likely to grow over time. Dividend investing doesn't always have to be about the long game, but if you really want to thrive on growing your passive income, it pays to think smaller, at least initially. Finally, remember to take your time. If you are just starting out in the stock market, and have the time to watch things grow, change, and to learn, then you should. Again, do not invest in something simply because it has a high dividend yield. Instead, focus on growing your smaller dividends. That means taking the time to research the current market, budding companies, and learning how to read the signs. Getting £1,000 a month in dividend income isn't a race, and even if it was, it's a marathon, not a sprint. If you are looking for quick ways to generate passive income, dividend investing is perhaps not the best avenue for you to take. If you are looking for quick ways to generate passive income, dividend investing is perhaps not the best avenue for you to take. Thanks for watching.